Good afternoon. Hello. So, my name's Joe Stallard. I'm the Managing Director here at House and Holiday Home Mortgages. And today we're going to try and take away some of the mystique that is around the holiday let mortgage. It's still a niche, quirky area of lending, but it has been a growing one. So, let's have a look at making this as simple as possible for people to help them understand the basics of a holiday let mortgage and work out if it's an area of investment that you want to get into. So, we're going to look at how lenders assess affordability. And when we say affordability, we simply mean how much you can borrow. We're going to look at what is really going to drive that approval decision with the mortgage application. And we're going to look at the opposite of that and look at areas where applications commonly go wrong. And by knowing all of these three pieces, you can really work out and put yourselves in the best position, whether you use a broker like myself or not, to really get that best chance of that approval decision on your holiday let mortgage. So let's start with some context. So holiday lets are a niche area of lending. That is absolutely true. There is, a small number of holiday let lenders compared to everybody in the country who lends on mortgages in general. However, it is a strong and a growing area that has seen a rise of demand, particularly probably built out through the COVID experience. Once we got out of lockdown, people were maybe not so keen to go and sit on an aeroplane for a while, but they still did need to get away and they still did need a break. And that's led to different pockets of the UK really experiencing tourism booms and lots of internal tourism as well. It's quite a nice thing to be able to load the car up and not have to deal with a baggage allowance. It's nice to be able to take the dog and not have to put him into kennels for a week. But that means that actually, your areas such as Cornwall and Devon and the Lake District have always done really well. But new pockets of the UK have really opened up to people. Your Norfolk coast, your Northumberlands, parts of Wales and Scotland. These have really seen some strong growth in terms of their holiday let numbers. Lenders have followed that trend. There is an increasing number of lenders coming into the holiday let market. Still none of the main high street banks and building societies, but good lenders who understand this market and who are looking for ways to diversify their lending portfolio. That increasing lender participation in turn has meant that we've seen more lenders starting to do more stuff. So criteria is improving. It's getting easier to access this type of lending. And as that happens, that means that lenders start competing on rate and price a little as well. So hopefully we can start to see these products get more competitive and more aligned with a buy-to-let mortgage or even a residential cost too. We're not there yet. There are still improvements to be made. This criteria is still inconsistent across lenders, but that inconsistency means that there are people who do different things. And so it's our job as a broker, when we get all these different factors, we're looking for these reasons that lenders are going to say no when it comes to a case, whether that's something to do with your personal circumstances or the property itself. So it's still a specialist and non-standard sector, but one that we are hopefully here to help you navigate. So why does all of this matter? Well, your holiday let is typically more complex than your standard residential or buy-to-let lending. There are additional underwriting considerations. So they still want to know about you as borrowers. They're still going to ask pretty much all the questions they would with a residential mortgage: your age, address history, your income, your credit commitments, your dependents, any adverse credit, all of this sort of stuff. But they're also then really interested in the property, because ultimately for most lenders, it's going to be the property's earning potential that drives their lending decision, how much they can borrow. So it's those additional requirements, understanding what the property is going to do, how it's going to perform, is going to be a key consideration on top of all the usual mortgage stuff. Then within that, each lender looks at things in a slightly different way. So whether that's a slightly different rental assessment, whether that's a different view on a complex property with some shared access or a grade listing, or, all of these multitude of factors that you really get into gives an idea about what each lender does on a different basis. So that misunderstanding of any criteria is often the thing that leads to a decline. If you've got your heart set on a particular mortgage rate because it's the best in the market, but actually you're buying a multi-unit property with residential on part of it and then multiple holiday cottages dotted around it, that's not standard lending. So actually getting to grips with your situation up front, understanding where you come from and how a lender's going to view it, is going to be the piece that leads to less declined or delayed applications. So let's have a look at how much you can borrow then, and crucially what goes into that factor. So residential wise, it's going to be your income and your credit commitments. For a buy to let, it's nice and simple because you have a consistent monthly rental value. When we look at holiday lets, we've obviously got seasonal properties here. So quite often the rent is going to be higher in the summer than it is in the winter. So what lenders will do is they will ask a holiday letting agent to provide a forecast for the property. That will give a weekly rate across low, mid and high seasons. So that rate is then typically averaged out. A number of weeks of the year are applied to it, along with some stress tests and some buffers to make sure that any void periods are accounted for, any costs are taken off, any potential rate rises are sort of built in there as safely as they can be. And that's how the lender's going to get to their lending amount for you. And we'll come through a couple of worked examples on that in a second. Where most people will start with understanding how much can I borrow and therefore sort of what value of property can I look for is really this working backwards from the deposit. So within the holiday let world, you do need a larger deposit starting from 20% of the purchase price, with more lending options coming in at 25%. So then let's dive into this idea about the low, mid and high seasons. So these income projections are going to be provided by a holiday letting agent. It can be a large national company, it can be a smaller reputable company that knows your area inside and out. There's no obligation to go on and work with that company. Often they will give you the set of figures and as an opportunity to pitch to you and tell you why they should manage it for you. But ultimately, as long as they're reputable and the lender can, through their own means, sense check the figures they're giving you, it's going to be that letter that not only gives you an idea as a buyer how much it's going to produce for you, but it's going to be the figures that are used by a lender. So they'll take an average of your low, mid and high season weekly rates. They will put that across, say, 30 bookable weeks of the year, and then they will get to a borrowing figure there. Now, not all lenders use this particular method. It is the most common in the industry, but not everyone acts that way. So some will look at the property as if it were a buy-to-let and use that typical AST or tenancy document, and that will give the figure. They will still allow you to let it out as a holiday let, but it'll be calculated as a buy-to-let. Or perhaps even more rarely, there's this idea of it being treated on a residential calculation. So if you've got your own home mortgaged already, can you afford to go and run what would effectively be a second property? And then they would let you let it out there. So everyone does things slightly differently, but let's focus in on the low, mid, high view and have a look at how that might work. So within that, you will then take the average of your low, mid and high weekly rate. You will apply an interest coverage ratio to it. This basically means that there's a buffer built in to say that, right, we're going to say that we need to cover what we're doing here by about 130%. So there's that 30% buffer in from what we're looking for. And this varies lender to lender, typically around 125 to 145. But you can see instantly that the calculation becomes really important, and where all lenders are doing things differently, it can really matter. They will then apply a stress interest rate to that as well. And again, this varies by lender and by product term. Typically, a 5-year rate is stressed a little bit more generously, so maybe at 5.5%, for example, than a 2-year rate. And that's because there's a bit longer for that property to get established, do what it needs to do, and a bit more certainty from the lender's point of view as to how much it's going to earn. And from there, they're going to say, right, this is going to be rented out for 30 weeks of the year. And that gets you to the minimum annual rental that's required for that property. So what does that actually look like? Well, let's say then we are looking at a £400,000 purchase price, and we need a 75% loan on that, so a loan of £300,000. So we'll take our loan figure and times that by our stress rate, which in this case is 7.5%. Remember, these figures do vary per lender. They will change over time. So this is really just for illustrative purposes only, but it kind of hopefully illustrates how we get to the numbers we get to. That gives us a figure of £22,500. We then apply the coverage to that of 130%, which gets us up to needing a rental figure of just over £29,000 a year. We then divide that by the 30 weeks that the lender's saying the property is going to be rented out for, and that gets us to a figure of that average that we need, an average of £975 per bookable week to satisfy affordability here. Made up numbers, made up scenario, but fairly reflective of what goes on in the industry. And we will always run these calculations for you for, your specific set of figures and see where you need to get to. What we do find though is that because holiday lets can perform really nicely, in your traditional holiday let areas, these figures will stack up 9 times out of 10. So get certainty, find the right holiday letting agent to work with who's going to give you a set of figures, then either speak to the lender and understand how their calculation works, or come and we will do it across multiple lenders for you and give you a sense check of where that needs to land. But hopefully that helps illuminate how affordability is calculated within the holiday let market. So let's look at then some property considerations that you need to be aware of. So once you've had a look at, how much can I borrow, how much deposit do I have, focus then really switches to the property. And when a lender goes out and sends a valuer to look at the property, they are going to be making sure that there is demand for this. So is the property in good condition? Is it lettable, not livable? That's a really key phrase to remember. But they're also then going to have their own views on different locations and different local demands. So there's this idea that some holiday lenders only lend in your traditional holiday spots, whereas others are more open to the short let, your city breaks, your short stays, and understanding that there are different markets for different types of lenders. So location and local demand is really going to be an important driving factor. Beyond that, we've then got the actual type of property itself as well. So within houses, is there anything particularly unusual? Is there a complex access situation? Is there a grade listing? If it's a flat, is there a restriction on the property that means it can only be rented out as a holiday let? If it's a more complex property with multiple units or a house and an annex, be it an external or an internal annex, all of these factors are going to affect lender appetite and work within lender criteria or not. So really laying it out as clearly as possible from day one is important. Anything like planning usage or any restrictions or any short-term letting rules are going to be critical. Now, these are often only discovered during the legal phases, and quite often a mortgage offer can be given, and then when the solicitor gets into it and finds out that there are these restrictions on the property, then offers can be rescinded. So getting as much information as you possibly can from the agent, from the seller about the property, and really diving in and trying to establish whether there are any restrictions or anything to be aware of as early as possible can save yourself a lot of problems. They also want to know about you, the person behind the application. So just because it's a holiday let purchase, even if it's a limited company holiday let purchase, they still want to know who they're lending their money to. So anything like some previous landlord or even holiday let experience is helpful, but it's not always required. They are then going to want to know about what other commitments you have and your credit position and everything like you would be used to disclosing on a residential application. That's going to form part of it here too. Some lenders will have minimum salary income requirements. Some will have no adverse credit in the history as a requirement of their criteria. Really putting yourself in the cleanest position possible as a borrower is going to help before then the attention switches to the property and the income models and all of that piece we've just been through. So what common pitfalls then do we want to avoid? Well, I think the first one is that assuming that all lenders assess the holiday let the same way. If you had a decline decision, it could be very specific to that lender. It could be something there is another home for elsewhere, but if you're not getting enough borrowing with one lender, you might be able to with another. So they will all do things and see things slightly differently, and making sure you get as much of your situation disclosed up front as possible to try and get the right view before you put an application in is really going to help your success chances. I think when it comes to the income forecast, yes, a lender is going to rely on a holiday letting agent and a specialist to give them a set of figures for that property. But if that's completely unrealistic and it doesn't stack up when doing a sense check, or the lender's own valuer gives their expertise on the area, then those unrealistic forecasts are going to get pushed back on. Just because it's on a piece of paper doesn't mean it's necessarily true. So do your own research, get confident with your set of figures, and then hopefully that will stack up with a lender too. And don't choose the lender up front. I think, if you're going to do this yourself, really get to the grips of, right, what's difficult in my situation? What are the quirks with me or with the property? And then try and find the right lender for that. And if you're working with a broker, then they should be doing that bit for you, and they should be looking for those potential red flags, getting on top of those, and recommending a suitable product because of that. To take away then, so holiday let mortgages are specialist. It's really a small, quirky, niche area of lending, which is great because it makes it nice and interesting, but it does mean that sometimes navigating that can be a little bit more complex than it might be otherwise. These tend to be smaller lenders, smaller banks and building societies that are going to lend on these type of products. So, those instantly applications can take a little bit longer, can be a little bit more manual, but hopefully it gets the right decision for you. The conditions of the market are going to impact lender decisions and assessment criteria. So as rates go up, you can see that there were stress rates and everything built into the affordability calculations. That means that those are probably going to increase, and so that as rates go up, borrowing amounts are probably going to come down a little bit. And equally, their appetites for lending are going to vary and fluctuate depending on the sorts of business they're taking on at any one time. So just because you had a set of figures a year ago or thought you knew what you're doing, things can change. So it's worth remembering to get up to date. And I'm a little bit biased with this last point of view, of course I am, but I think expert guidance can really help navigate through this journey and make it as simple as possible for you. Getting that preparation done up front and working with the right people, whether that's the right holiday letting agent, the right team of cleaners, or the right mortgage broker, can be really key to your holiday let success. So who are we? So we're House and Holiday Home Mortgages. We've been specialising in this area of lending since 2015. We've worked with a number of lenders to help shape their criteria and get across what borrowers like yourself actually need from these products. So we have a good panel of lenders that we work with. If we can't do it with them, we have access to go around that panel as well, and really try and find a home for this type of lending for you. We try and make everything as straightforward as possible. We believe in making things simple and honest and building that long-term relationship through our relationships with clients and helping you with your holiday let, but then also with all the other properties in your portfolio, whether it be other investment properties or your residential home too. Now, if there are any questions, I can take a view of that now. Let me just open up some of the Q&A here. Right, so we've had the first question in. Do lenders place limits on how many weeks per year there must be let to qualify? Yes, so that was built in. If we go back here, so it's this idea of this 30-week figure. So most will use 30 weeks of the 52 in the calendar year that the property will be rented out for. Some will go above that if the agent or if we're remortgaging can showcase that actually the property does do more than that. Some might extend that 30 weeks out further. Some might be a little bit more cautious and take that 30 weeks down as well. So all lenders will do things slightly differently. And that's where I guess the nuance of your situation becomes really, really important. How do interest rates for holiday mortgages compared to standard buy-to-let products. Okay, so this idea of interest rate is an important one. It's also one that is quite easily manipulated. So by that, I mean that it's very easy for a lender to chop the rate right down and charge you a 2 point something percent rate, but then whack a great 30 grand fee on there. And so the rate looks amazing, but actually the whole cost of borrowing is no different. That's what we've seen in sort of the buy-to-let market in a number of cases. There are these lower rate products with higher upfront fees to get around some of the stress testing requirements and make sure that the borrowing is doable in that sector due to some of the tax changes and stuff we won't go into here. I would say, to answer your question more generally and being less picky about it, holiday lets rates are similar, if not a shade higher than buy-to-let, and buy-to-let rates are similar, if not a shade higher than residential rates as we sit and speak here today. But I think crucially, it's not all about rate. We will always look at the overall cost of borrowing and take into account other fees. And I think that will change over time as well. To get an up-to-date view of your circumstances and your situation at the time, speak to a specialist and really see where the figures are coming out for you. One more question. How might upcoming regulations or local council restrictions impact mortgage eligibility in the future? Yeah, good question. It's obviously an area that has been in particular interest of, cheap political headlines and how blaming the UK holiday let for all of the problems without considering any of the value it drives to the UK economy. I think, look, we've seen that more lenders are coming into this place. We've seen that more lenders are improving their criteria, and that's fundamentally because they have back books of clients who are not going into arrears on this type of property. So that's a good sign for the industry. Yes, regulation and particular localized regulation can make things more difficult, and it will have an impact. But ultimately, the lender is going to be driven by what they can legally do. So the solicitor on the application works for you, but they will also, in most circumstances, work for the lender as well. So it's then their job to make sure that you're complying with everything you need to comply to, and that fits with the lender's criteria. I think as we see restrictions come into place, that will get fed down into criteria and may put restrictions on certain particular lenders, lending criteria and what they will do. We've seen through licensing in Scotland that sometimes those lenders who do lend in Scotland will want to see a license in place or make it a condition of the mortgage offer that before that money can be released, that license needs to be displayed and evidenced. So I think that's going to be a really situational case-by-case example. But for now, I think whilst there is no, truly widespread regulation holding anything back, then lenders will continue to do what they can and lend money effectively until they hear otherwise. Okay, all right. I think that is all the questions. So look, if there's anything anyone wants to ask privately, my email address is there. You can find us at hhhmortgages.com. You can give us a call on 01453 887179. We offer fee-free, no obligation initial chats with people, and then if we are the right people for you, we'll go on and explain our sort of fee structure beyond that. But if you just want a sense check of what you're doing or to get a flavour as to how we might be able to help you, get in touch and we will certainly love to do so. Thank you all for joining. I hope that's been useful. Cheers.